on YouTube.
Great. Yeah, I can see it's
Live on
live.
YouTube. Let's go
Okay,
on.
gentlemen, we need to make a start.
Yep.
Yeah,
Great. So
I'm admitting all now.
can you all, Anurag, can you turn everybody mute and accept me and then just a speaker, please?
I've muted all. You can unmute yourself.
give me
Everybody's muted now. And Anurag, shall I open the gates? Okay, I'm opening the gates. You are muted, Anurag. And whoever is the first speaker, take over.
Yeah. Can you hear me and sharing the screen? Can you see that? Great. Go ahead. Jai Jinendra, good morning and namaste. Welcome to Jito UK's Economy and Investment Series with the first session on building growth portfolio. We have financial markets and macroeconomy expert Ashok Shah and passionate investor Narendra Singhal to share their thoughts and recommendations on market trends and opportunities for investment. Before we start, I would like to make a disclaimer that just to all participants and notify that this session is being recorded and live on YouTube channel. So by participating here, you are consenting to this recording. Any questions, please reach out to Jito organizers. Many thanks. Before I commence, I would like to invite our chairperson Nimesh Mehta to kick off the session with Navkar Mantra and brief message. Nimesh bhai, over to you, please. I can't hear. I think you need to unmute Nimesh bhai.
Good morning, everybody. Welcome to the first event for 2021. As always, we start with Navkar Mantra. So if you close your eyes and let's put ourselves into a nice posture place in our mind and just recite Navkar Mantra. Namo Arihantanam, Namo Siddhanam, Namo Ayaryanam, Namo Vajjayanam, Namo Loye Sawa Sahunam, Eso Pancha Namo Karo, Sawa Pava Prasano, Mangalanam Cha Sawa Sim. Om Shanti. Thank you all very much. So I'm very delighted to launch our first event for 2021. First of all, welcome everybody. I would like to thank Kiran Bhai Mehta, that some of you will see on your screen, who has chaired Jito UK for the last 4 years and basically brought it up from a standing start. So to Kiran Bhai and the past committee, thank you all very much. We have a very busy schedule planned for this next year, and we look forward to making a lot of new friends and meeting all of you online as soon as we can, and ideally physically as soon as we can as well, to have a cup of chai and discuss whatever we need to do. The UK board plan is to work at the grassroots in the UK so we can inspire entrepreneurship, generate more trade between Jains, which is the mission of Jito, and to create better networking between ourselves professionally, business-wise, and even just for advice and social community cohesion. Jito UK bridges the divide between the traditional Jain communities in the UK, and it aims to be a place of friendship for new Jains entering the UK. And we really look forward to the established families and the established professionals already settled in the UK to help the new people and the new families come up in business. So I'm very delighted to say we have an expanded committee, 16 board members, all of whom are extremely experienced and very talented people, as well as our 4 trustees from before. So the board now has 11 new members, and I'm going to be extremely busy trying to keep tabs on everybody, or they might make me very busy trying to progress stuff as well. So it's an unusual way to start this committee and this term, but you know, our school children have adapted, our university graduates have adapted, the university freshers have had to adapt, and we have adapted as a committee. The team has been exceptional so far. We have organized quite a lot of events that Nitin will take us through. But I promise my board that we will have a joint dinner with some entertainment and masti and maja as soon as we can. So it's been a very challenging year for all of us, and I'm sure we all look forward to return to some kind of normal life. But I think it's safe to say it's going to be a new normal. Some of the things which we have learned that have helped us cope during the pandemic are now here to stay. So those of us who adapt well to change and look forward with optimism will do well. And I urge all our members and everybody online to be optimistic. Look for ways to try and do things and take advantage of the new normal. Whether it's to be thinking in a different way, whether it's to assume that people can do more than we've ever thought before, and even in letting go of the thinking, it isn't done in this way. Let go of that, because we have seen so many new ways of doing things. And people have got lots of things done in a completely new way with technology, with different thinking. So let's free our mind and look for opportunities. So talking of opportunities, there's a new budget around the corner, and we look forward to the opportunities that it will bring as Rishi tries a balancing act between holding back the finances and encouraging the economy. And in that sense, we have an event lined up just after the budget to talk about the opportunities there. We also have another 3 events lined up until the middle of April, alongside a couple of longer term series, one of which is very exciting, which is to try and teach ladies of a certain age financial life skills. And we'll go more into that as we get closer to the launch of that. We also have launched a support system for students from India who might be alone and struggling in the UK, and for those who want to ask questions about what the UK is like, what they have to do if they're coming over. And that is a really very good initiative, and any members online who can help with that, please get in touch with us. As well as this, about 4 of us in the JITO board have been instrumental in helping set up a One Jain project called the Jain Health Initiative, the JHI. In 6 weeks, since about the end of December, beginning of January, we've hosted 3 webinars and 1 resource platform has been created. 30,000 Jains, that's 30,000 Jains which is approximately 1/3 of the Jain population of the UK, have watched these videos. Okay, and so it's the most amazing thing was that how big a project could have been achieved in such a short time when people with a vision and the capability got together and acted out of goodwill. And really, COVID-19 has in that way brought people together in a very different way. I see a similar need, not just for health matters, but for business help. So JITO is considering helping start a Jain business support hub. There will be traders and professionals who have been adversely affected by the pandemic. If any of you have ideas to help, if you can offer your services as a business professional, please get in touch with us so that we can try and get the same thing up and running for people in business who need help. As always, we welcome help from the community, and if you're an expert in something and you would like a platform to talk about that field, you're very welcome to give us a call. If you have an idea for an event, give us a call. So finally, to you, the members, the people who come online to listen to Ashok Bhai and Naren, we really do what we do to help the community prosper financially and socially. So those of you who are online and are not members of JITO, please join. We run entirely on membership and sponsorship, and some of our events will be for paid members only, including our networking event and the business directory with referrals to overseas chapters. JITO UK is part of a bigger group. There are 11 overseas chapters. Overseas means outside of India, and there are 65 chapters in India. So if you need to make a Jain business contact in a lot of different countries, JITO is a really good place to start. For membership, Nitin will talk about that a little bit more later on. So, and finally, talking of memberships, I'd like to thank all the people who are patrons of JITO UK and have shown faith in the vision that we have, and in particular to our platinum sponsor Comline Limited. Comline is a business started in 1991 with Divyesh Kamdar and his family, and it's a leading independent supplier of aftermarket replacement car parts. They have hubs in 4 countries, and they've offered us tremendous support over the last year, and we look forward to continuing that partnership. So now let me hand over to Nitin for today's exciting opportunity, where Ashok Bhai is going to talk to us about the new opportunities after urging caution last year. So Nitin, it's time to ring the session bell on the opening of 2021. Thank you.
Thank you, Nimesh Bhai. Thank you. So it's a great start to begin the session with Ashok Bhai with starting the markets and economy. So before I start, I'd like to just present again the disclaimer. We live in the world of terms and conditions and asterisks. So again, we Jito can't avoid those. So just to as a read is the information provided in this program is general guidance and drawn from presenters' personal experience and not intended as a specific financial advice, and does not necessarily represent the views of Jito UK, organizers, sponsors, or any participating entity. Individuals are recommended to seek professional advice as appropriate before making any financial decision. So hope that makes it clear in terms of disclaimer. Now, I would like to introduce Ashok Bhai, and many of us already know him, and he's really known for his expertise. So before I pass the baton to Ashok Bhai, just to give a background of him, Ashok Shah has over 40 years of experience with investment and financial markets. He is investment director at London Capital since 2012, and before that, he had held position as a chief investment officer and head of global investment strategy between 2002 and 2012. Prior to joining London Capital, he was head of emerging market equities at Old Mutual Asset Manager. Ashok Shah is a frequent speaker and commentator on CNBC's Squawk Box Europe. Without further ado, Ashok Bhai, please welcome.
Ashok Bhai, unmute yourself.
Okay, unmute. Good morning, everybody. I hope you have a very good, informative session today. What I want to do is really first reaffirm the health warning, which is basically that everybody's needs and requirements are different in terms of your time horizon, the attitude to risk, how much loss you can absorb, how much income requirement you have, and so on. So just make sure that what we say here is not meant as a direct personal advice. If necessary, please get help of an investment professional to help you manage if you need that. So that's my health warning to start off with. What I want to do is now begin the session by saying that we live in a very interesting times right now. What COVID has done effectively has put us in a very, very unusual circumstances. And in order to summarize all of this, can we go to the slide, which is the factors? Okay, yeah, that's one. So I want to summarize where we are. It's quite a complex situation out there in the world. So I tried to put it into 3 categories. What is good out there, what is not so good, and what really is troubling or worrying. And then we can put all of this together and figure out what the path ahead should be. So let's just focus on what the responses from the governments and the central bankers have been in terms of how to help us come out of the crisis that COVID put us all into. So the first thing that happened really was that a political decision was made effectively to close more than 50% of the economy. And that created, as a byproduct straight away, a massive recession, huge, probably the deepest anyone has ever seen. And in order to stop the recession becoming a depression like 1929, because recessions can feed on themselves, and it's the job of the central bankers and governments to step in and try and stop the rot and then engineer recovery. So what the central bankers did effectively was to take us into a world of zero interest rates, and for half of the developed world is in negative interest rate structure. So effectively the cost of borrowing was cut right down to zero. And that was really not enough of a help when you think about the magnitude of the recession that we were talking about. At one point, On a quarter-on-quarter, we were contracting at around 30% annualized rate, which is mind-boggling. So the central bankers then engaged in effectively printing whatever new amount of money that was needed and effectively called quantitative easing. So the US went into unlimited quantitative easing. Bank of Japan had always been in unlimited quantitative easing. And then it's soon joined by the European Central Bank and of course Bank of England as well in a manner. Bank of China printed a lot of money, but it wasn't in unlimited QE and stopped earlier simply because it was growing so fast. The downturn was not as bad as the others. So effectively, when you think about the monetary policy, it's been as loose, as flexible, as helpful as it ever been. And one of the things that the Federal Reserve Bank did was that when we were in end of March, beginning of April of last year, the markets were in a free fall. In other words, there were really no buyers stepping in. And it was quite clear at that stage that things could get pretty awful very fast. So the Federal Reserve Bank stepped in to effectively backstop most components of the fixed income markets and become buyer of the last resort. So in many of the fixed income securities where it's not like equities, where it's the continuous trading, you're going to find counterparties to become your opposite party. And in that sense, the lack of counterparties meant that the prices were being marked down 10, 20 points pretty fast. So that's pretty disastrous for fixed income part of the asset markets. So the idea really from the Federal Reserve Bank was to first stop the road and then becoming buyer for last resort. It can dictate the clearing prices because at the margin, it's the largest buyer, and the largest buyer effectively determines the clearing prices. And the idea really for the central banker was to drive the prices up. And why would the central banker want to drive the prices of the fixed income asset market up? Well, the answer lies in the fact that, over the next 12 months at the point of the crisis, there would have been a lot of existing debt that was going to mature. And that meant that the companies would be hard put to renew the maturity of their debt portfolios. So this way, the cost of renewing, the coupons that the companies have to pay can actually go down. So it makes it much, much cheaper and easier to roll over the maturing credits. And additionally, any company, anybody who wanted to raise new finance, having liquidity provided and bringing the cost of capital down meant that companies could raise new money fairly quickly. So effectively, the financial markets, which had stopped functioning, actually opened up and started to function properly like they should. And in some countries, like in Japan and Switzerland, the central bankers went further ahead and also bought equity markets as well. So that meant that the monetary policy was incredibly helpful for the economic growth and financial markets. So we would normally say that is very, very good. Then if you think about the actions that the governments took, technically forced to take, but they actually willingly took, was that they went into, do whatever it takes to stop the road. And that effectively meant that if there were any limits on budget deficit spending, they were all put aside, and the governments effectively opened the taps to the widest level possible. So if you think about, for example, what the budget deficit in the US was, at the beginning of last year, it was running around 4.5% in that region. And with the new deficit spending that the US government took place, the budget deficit, in the end, when it's finally worked out, probably around 18% of the GDP. Numbers of this magnitude were probably never seen until the First World War and the Second World War. And if you think about the Biden package, which is now got last night approval in the Congress, and obviously has to go to the Senate as well. If you put that is a $1.9 trillion package, that is genuinely massive. So it looks like the budget deficit for this year for the US is going to be another 18%. So these are massive numbers of government spending to keep the economies going and stop them from falling off the cliff. And so that would be very, very positive indeed. And if you think about all of the developed countries, they are all engaged in very similar policies of, very large scale spending. So that's incredibly good. And what Biden package will do effectively is that it adds around 5 to 6% in terms of the 2021 growth. So that's a massive boost to the GDP. And why would we need such a massive boost to the GDP? Because we still got around 10 million people who lost job in the US. And so they need to be put back into work. And we need a mini economic boom to put these people back into work. And remember that, you cannot create sustainable growth unless you have sustainable consumption cycle. And you cannot create a sustainable consumption cycle unless you have stable and good employment cycle. And so all of these things are needed so that the longer term growth prospects become a little bit stable and better and positive. So we would say that, I would say that, the fiscal policy is incredibly loose. And of course, from a market point of view, that's very, very good. But of course, there is a cost to this. And the cost to this really is the fact that the government debt to GDP, they are rising very, very quickly for whole of the world and mostly in the developed countries. So, what the end of the COVID, what the government debt to GDP would look like, would vary from around 120% for countries like UK and the US to 160% for, say, Italy, 150% for Spain, for example. And of course, Japan is in its own league of around 250% of GDP. But generally, what the COVID crisis has done is to put between 20 and 30% extra government debt on the balance sheet. So that basically means that we have a massive debt burden, which will have to be unwound over the coming years. And one of the byproducts of this huge increase in indebtedness is that the ability to raise interest rate is that much more restrained without causing a massive default cycle, a massive, chaos in the economy. So yes, interest rates will rise, but very slowly, very gradually, over a very long, slow period. So no panic, even though in the last 2 weeks, the markets are in a mini state of panic with a big sell-off in the bond market on the expectation that the inflation is going to be picking up a little bit more quickly because what Biden package does, it creates a mini economic boom. So the extra growth that it creates absorbs the spare capacity much more quickly than earlier thought. And of course, brings the pricing pressures a little bit nearer. So, effectively, if you went back a month, 2 months ago, the market expectation was that interest rates in the US would not be raised until probably towards the end of 2024. And in the last 2 weeks, it's probably brought it forward by about a year. So what the huge package that is going through the Congress and then through the Senate soon, what that does is it brings forward the inflation point about a year. So it's not that big, but it's big because when interest rates are very, very low, even small changes, they have a much bigger impact. So when you're a world of zero interest rates, a quarter point is a very, very big rate rise. What I want to talk about is the middle column, which is a little bit of a less bad news. So, despite, what we have seen, the world in terms of negative interest rate structure, at this point in time, if you had looked at the total quantum of bonds that yield negative interest rates, remember, these are bonds, if you buy and held to maturity, you are guaranteed to make a loss in nominal terms. So that quantity had exceeded $18 trillion. The size of the US economy is around $21 trillion, just to get our minds around the quantum of negative yielding debt. And in the last 2-3 weeks, with the minor change in interest rate, that negative yielding debt has reduced to just around $13.5 trillion. So still a very large quantity, and it tells you the amount of help that the world economy needs to going at the rate it is going right now. And of course, the other really less good is that, the tensions between US and China, they are not going to disappear because Biden's policies, announced now that there's going to be continuation of the Trump policy in terms of all the increased intentions that US had with China in terms of the proliferation threat of the IT technology from the US and so forth. So I think that creates a lot of tension and restrictions on companies and so forth. So that really is not that good. The other thing really is the consumer spending. Now, even though huge amount of money has been supplied to families directly to stop the repeat of 1929 soup kitchen, the modern version of the soup kitchen is that the government simply give money straight to families. Like the generation now we are in is the arrival of helicopter money. So money is being given to the families free. But that's really to make sure they do not starve. So the money that they get is just to pay for milk and bread and very few basic necessities. But the other help that has been given to the families through furlough schemes and so on, a large percentage of that actually initially was not spent. So the savings rate went up and people were worried, if I don't have a job, what am I going to do? My savings are going to run down, things like that. So in the last 3 months, the savings rates have come down, but they're still significantly higher than historical averages. And in time, those will come down as well. So that is not good in the short term because savings slows the economic cycle. And we already have a surplus of savings in the world, which is one of the reasons why we have such low interest rates. And the other thing which is less good really for us because we are in UK was obviously Brexit, and we had this overhanging us for almost 4 or 5 years. But now, the Brexit is behind us, and we are now obviously finding our feet, and we have seen, for example, sterling recover very smartly. It fell, from around 145.50 level to 120, and it's around 140 now. So as the uncertainties on Brexit have dissipated, sterling is slowly going towards its neutral value. But of course, what Brexit did was that it stopped the capital spending cycle. And without a capital spending cycle, you can't really create an employment cycle and prosperity. So those were less good, but hopefully in the next 2-3 years, we will slowly find our feet and begin to get capital spending cycle. So, even though UK has been on a much lower growth trajectory than many of our competitors, hopefully in the next 5 years, we will probably be slightly better. Now, in terms of what worries us the most, really, first is obviously on COVID itself, and now the main thing about the COVID, with the arrival of the vaccines, which is very, very good news, of course, is the variants and whether mutations, are going to be tackled or not. So it's something we worry about, but right now, the pace at which vaccinations are being delivered is incredibly encouraging, and of course, very, very good news. But at the end of what has happened is that the world that we live in has become very highly indebted, and we have a lot of leverage loans there. A lot of balance sheets are very, very leveraged, which means that there is a very low resilience in terms of the financial system, both in terms of corporate borrowings have gone up and the government borrowings have gone up. And that is worrying because if for whatever reason, unknown, interest rates have to be raised, then we are looking at a very distressing situation. So it's a risk which is not imminent, but something we should keep our eyes open for, that the absolute levels of debt and the leverage loans out there, continue to cause a little bit of anxiety. And the last point I want to just mention really is one of the passive investing, which is index tracking funds, ETFs. So more and more money that is invested into the financial markets is bypassing investment managers, because historically investment managers charge fees, but they underperform the underlying market indices. They don't necessarily add value. So there was a very good reason for investors and institutions picking up passive instruments, which are very cost efficient and very low unit cost. But the point really was that when the quantum of money going into the markets via the passive instruments was small, they have always been price takers. But now that they're very large, the function of price making has changed. They actually become price determiners, not price takers, because they're so big. That basically means that you could easily get a move one way or the other, and the market could go into a singularity. In other words, get a jump risk. And that is why, for example, we had the jump risk in end of March, beginning of April of last year. And then the central bankers had to step in to stabilize the market. But as the quantum of passive money rises, that risk rises even further. So something to just worry about, that the way the market making function itself works is it's very unstable in itself. And of course, in today's world, algorithms or computerized trading often comprises more than 80% of daily trading. So that's really one computer trading against another computer. And poor humans have no chance of really functioning in that environment. At the margin, you think you can be a great trader, but believe me, you will not be able to beat the computers. They're gonna, take the mickey out of you. So just be aware you've been warned. Can we please go to the next slide? Okay, so I just wanted to sum a lot of the things into just 5 factors out there, because there's so many factors. So I picked up the 5 ones and then try and make heads or tail out of that to allow us to navigate, how one's assets should be managed. So as I mentioned, if you look at the monetary policy as one of the most important traffic light, if you want to call it traffic light signals, then of course, as I said, it's incredibly easy, it's very loose. So I would say that it's deep green, yeah, it's reading fine, everything is great, and it's going to remain like that for a period of time. Then if you look at the fiscal policy, of course, even though this year looks very, very good in terms of, a Biden package and what Rishi Sunak is soon going to do and what the Europeans in the Eurozone are doing, then you said that there's going to be huge government support still unrolling. But I think that as quarters go by and as the economy gets a bit more stable, then some help is going to be reduced in terms of budget deficit spending. So even though it's very, very green and it's going to be green for a couple of quarters, I think it's going to change its direction as we get towards the 12 months from now. And then when we look at the valuations, I think that there is cause for concern. And the cause for concern really is to do with the fact that if you took the long time, so if you focus on S&P 500 as the main market, because all markets tend to run off S&P 500 to an extent. So if you look at the valuations in long term, over the last 50 years of S&P 500, and you said, where are the current valuations in relation to its long-term average? Then it's in the top decile. So it is as expensive as markets really can be. So I would say it's very, very expensive. And the chances are that given the huge liquidity in the system that the central bankers are pumping in, then the valuations of the market will continue to remain red for a few quarters to come. So it remains in a red zone. And then if we look at the next factor, which is really the corporate earnings growth, and if you look at the corporate earnings growth for S&P 500, the consensus earnings estimate for this year is 23%. And for next year, believe it or not, it's just shy of 20%. So the market has already discounted large earnings growth to come from the corporate sector over the next 12, 24 months. So when we think about really over the last 12 months, what happened? The market was effectively divided into 2. One was the beneficiaries of the COVID, which were the usual mob, the IT companies and the pharmaceuticals and the biotechs. Because the living patterns change, the working habits change, so forth. And that basically meant that these companies, the trends that were in force were just reinforced. And that meant that these companies expanded their businesses and were able to, get a lot more turnover and profits going through. But the rest of the market, where the economies were closed down and so on, of course, they were in turmoil. So it's a two half of the market. And when you think about the weightings of the technology stocks and pharmaceuticals for S&P 500, it's in excess of 25, just shy of 30%. So almost 70% of the index was hurting bad. But those IT companies and biotechs were able to take the whole index up. So because their earnings growth is already a new peak, and then to grow them at more than double digit for the next 12, 24 months, I think is asking a lot. And of course, it ignores all the regulatory risks, antitrust regulation, breakup risks, and all that. But for the rest of the market, it will be possible to recover as the economy finds its feet. And so in that sense, the valuation of the market, even though influenced by the IT, looks high, but if you break it down, then there are large parts of the market where the valuations are acceptable. It's only the top bit where one needs to be careful. So if you looked at companies like Tesla, which is now the 5th largest company in S&P 500, huge PER, so very, very high valuations and so forth. And earnings expectations also very, very high. And if you look at the last kind of traffic light signal that I want us to focus on, is what I would call sentiment. And typically this is a contracyclical indicator. But where we are right now is that the market has been almost until last week in a euphoric state. And the way one comes to that kind of a judgment is that you just need to look at what Bitcoin did, for example, or what the special purpose acquisition companies are all about, where you're buying businesses, you actually don't even know what the revenues are. You don't even know what the balance sheet is going to be. You don't even know what the business of that company is going to be because you don't know what they're going to absorb. And they're all kind of listed on the first day, the price is up 10, 20, 30%. So this is the height of speculation. If you look at companies like Tesla and what it's done, again, so it's telling you that the sentiment had become euphoric. And typically it doesn't stay in a euphoric state for long enough. And from investment point of view, this is always a danger signal. You want to look at and buy assets when they are neglected, when everybody is pessimistic, then value is available on the table. So again, I would say that it's between red and amber kind of a signal. So if we sum all of this together, then what we are getting is a very, very confusing picture. Very difficult. You got green, red, and in the middle. And so it's not a clear cut of good or bad in terms of investing money. So can we go to the next slide, please?
Yeah.
So in order to get our minds around, how much risk should we put in our portfolios, and what kind of risk should we embed in our portfolios? So the best way to think is to think of an economic cycle and the financial cycle. And the markets tend to discount the economic cycle because they are forward-looking. So, it might be 1, 2, 3 quarters ahead of it. So when you come out of a recession and you're sure you're out of the recession, that is the time when whatever is your maximum risk allowance is what you should embed in your portfolio. And then you got many years ahead of you when the economy is going to be on a strengthening, improving mode, so that the companies have a long period, many years ahead of them to generate corporate earnings growth, expand their sales and volumes and profitability and so on. And then, of course, the way you go through it is that you start with your early cycle asset allocation. And then as you go through the cycle, you will have mid-cycle asset allocation. And when you get into the mature part of the economic cycle, you would have the mature cycle asset allocation, where every quarter that goes by, you begin to reduce risk. And of course, nobody knows when an economic cycle is going to end. Like the last cycle ended with the COVID, but nobody would have been able to guess it. So you never can time when the cycle ends, why it ends. It's always going to be unknown. So the best thing to do is that, you want to keep dancing, but every step that you take is towards the closer to the exit door, not further away from the exit door when you're in the mature part of the cycle. So in terms of, therefore, where are we now? And obviously here and now, in the first quarter of this year, UK and Europe, actually, we are in a mini recession. We are contracting again because of the increased lockdowns that we had in the last 2 months. But if you think about what the Biden package is going to do, and the fact that the vaccines now getting delivered and circulated much faster. So if you look at, for example, the total vaccine capacity for this year for the world, is around 8 billion doses. When you take the top 10 vaccines, those that are approved and those that are about to be approved, Johnson & Johnson, which is a one-shot vaccine, got approved yesterday. and in the US. So again, that's very, very good news. So in terms of the developed world, it is quite likely that close to 75% of the adult population will get vaccinated in some time in the third quarter of this year. And for emerging economies, probably end of the year or beginning of next year. And that's simply because we all know that distributing, transporting the vaccines in emerging economies is going to be a little more difficult and more challenging. But if we focus on the developed countries, it basically means that the economies in third quarter are going to be a lot more fully opened up and probably going gangbusters in Q4 and Q1 of next year. So we're going to get something.
Sorry, Ashok, by interfering, but it's just a 60-second more, and then we can perhaps cover more in the detail in the next round. So sorry to interview that. Yeah.
All right, no, that's fine. So all I was going to say is that expect a massive economic boom in the developed countries in the second half of this year, first half of next year. And obviously emerging economies, they are basically a warrant on the developed world. So they're going to have even a bigger boom with a 3-month lag or almost synchronous. So I'm going to leave it at that for now, and then we'll take it in Q&A. Thank you.
Thank you so much, Ashok bhai. It's been, as always, you come with a great insights and stimulating facts. And I'd like to, and we have several questions coming from the audience as well. So, we will definitely have a more extensive and interesting session. By the way, just for the audiences, we have got a permission to extend the Q&A sessions. Both are available. So we might be having, interesting discussions later on the similar topics. So just to bring back the session on the, let me just share the slide. Okay, so before I move to the next speaker, our Narendra Singhal, I would like to just make some announcement. And one of them is, about the upcoming events. GT UK team has lined up several events in coming months across various themes. And here is the list of events. You're seeing it. And please visit our page, gtouk.org/events, and you will find more information about them as well as for opportunity for registration. That's one announcement I want to quickly make it. The second one is, as Nimesh bhai highlighted, I'm the primary contact for membership, but any board member, any GITO key person is reachable for getting more information on membership as well. And why you should join thinking about GITO if you're not a member is because you will be able to connect with the like-minded people locally and globally for business ideas, trade opportunities, and professional development. So, and also you will get exclusive featured services for GITO members, which is what GITO team is trying to aggregate for the key members, annual members, and patrons. So please visit our page, gtouk.org, become a member, or contact on below information. And the last announcement I would like to make is about the census. And you may have come across this from various forums too, but I would like to remind you all to participate in complete census on Census 2021. That's coming on March 21st. Remember the question 16. Choose other, select Jane. This is very important for Jane community to identify correct numbers to drive desired changes and support from Westminsters and policymakers. Thank you all. All announcement done. And now it's time to introduce our second guest speaker, Narendra Singhal. Narendra Singhal is a chartered accountant with 18 plus years of experience in financial services industry. Narendra has a rich experience in business, process outsourcing, business transformation, change management, and financial data governance management, with domain expertise in equities, fixed income, and currencies. Narendra has been providing consultancy services to leading investment bank and with Deutsche Bank, HSBC, RBS, Lehman Brothers, ABN AMRO, and much more. Narendra Singhal is a passionate follower of financial market and likes to read economics in leisure time. He is an active investor in stock markets, believe in long-term investing, and uses structured process to build stock portfolio to meet his financial objectives. So without further delay, please welcome Narendra bhai, who will share his experience and strategy to building a portfolio. So I'd like to share, and Narendra bhai, can you share the screen? Yeah, I can see it.
Narendra bhai, unmute
Yeah.
yourself.
Perfect. So yeah, over to you.
All right. Yeah. Okay. All
Would
right.
you mind doing the presentation mode, please?
Narendra bhai, the slider at the bottom, next to it, the first icon.
Hang on.
At the bottom of your screen in PowerPoint, the slider for zoom out, zoom in.
Or you may just press at the top from beginning on the top left corner and should do the presentation.
Don't worry, let's start.
Yeah.
Yeah, one moment. I'm just sharing the screen. Can you see the screen?
Yes, we can.
All right. Okay.
I
There
think
you
you
go.
have two screens. Full presentation mode might be on the other one. Yeah.
There
Okay.
you go. Works. Perfect.
Okay. All right. And just a small disclaimer before we start. I mean, all the opportunities which I present here has got different risk profile, and it may not suit everyone. So please take adequate care when you decide in which stock to invest and in what proportion. Yeah, so just a small disclaimer because some of those stocks could be risky. So unless your portfolio doesn't have the appetite um, to include those stocks, then please refrain from adding them. Cool. Okay, so a few things I wanted to cover today. First of all, we'll look at retail investors. How do they manage their portfolio? What investment options they've got to invest in each asset class. A trend among the retail investors, how they have been approaching to invest in equities market. And then we'll look at few emerging investment themes that an investor could look at to invest for the foreseeable future. Yeah. Cool. Okay. So a traditional approach, I mean, for retail investor, it's very important that they maintain their portfolio in order to ensure that it meets their long-term financial needs. So normally, if you go to any investment professional or if you have got financial um, acumen, then you would first define your investment goals and risk tolerance before you start actually building a portfolio. And once you do that, you would want to decide, I mean, where do you fit? I mean, how do you structure your asset classes? So the asset classes which is normally available is equities, fixed income. Traditionally, people invest in gold to hedge against inflation. And then you would want to keep some amount of money as cash and cash equivalent for your immediate needs, right? So these are the traditional asset classes which is available. And if you look at the diagram on the right, I mean, normally a moderately aggressive portfolio based on your um, life cycle and your financial needs, people would normally invest around say 45 to 55% in equities, 25 to 35% in fixed income, and then gold and cash equivalent. Now, the challenge is once you decide, I mean, how much money you want to allocate against each asset class, the challenge is to pick up appropriate securities and assets in each of those investment class, right? And so once you do that, you also have to look at how do you monitor and rebalance the diversification of securities within each asset class, because while you invest in equities, there are possible that a handful of equities through a significant capital appreciation would dominate your the asset class. So you would want to diversify that risk. So that requires constant monitor and rebalancing. And based on that, you would also want to rebalance your asset class contribution as such as you age and also your financial needs change. So that would mean that you would want to uh, increase your proportion of each of those asset classes based on your needs, right? So this is a constant cycle, I mean, where you review your goals and risk tolerance, look at your asset classes, pick securities, monitor and rebalance. So that cycle goes on. But normally a person revisits that cycle every 3 to 5 years. Yeah. Okay, investment options in each of those asset classes. If you look at retail investors, normally when they pick up equities, they've got host of options, like they can go for exchange traded funds, which is normally index funds, and then you can go for funds. I mean, looking at themes, whether it's a growth fund or sector specific funds. And then you got retail equity investment trust opportunities, REITs, and then you can invest directly into shares as well. Fixed income, you got with the growing platform options you got now, you can invest in government and agency bonds, corporate bonds, treasury inflation protected securities as an hedge, and then you can also invest in funds which actually invest your money in fixed income, right? Gold, which has been very popular, especially among Asian communities, they normally traditionally people have been buying gold and holding gold, but of late, because of all the options that's available, people go for exchange traded funds, which is quite easier to hold your gold there. And if you're a bit more if you've got more risk appetite, then you can actually go and invest in gold miners as well, which gives you more upside. Okay, then the last asset class, which is cash and cash equivalent, which you normally keep it aside for your immediate needs. So you got your short-term certificate of deposits. You can invest them in bonds. You got the traditional bank fixed deposits, and you got instant saving accounts as well. Yep. Cool. So if you look at the asset class, which is equities, because the equities has always outperformed all other asset classes in the last century or so, and especially S&P 500, which has been a benchmark among all the index of the world, which has traditionally given around 10 to 11% annual average return in the last 10 years. So has been the most popular among investors. Now, if you see, I mean, in the last few years or so, ETFs have been a very attractive options for people to invest, and people have been flocking to invest, especially in US equities or index funds, because they've become the bellwether of the benchmark to derive your returns. And the most popular ones would have been the S&P 500. So you got options like, for UK investors, you got HSBC, through which you can gain access to the index. Nasdaq, which has actually significantly outperformed S&P in last 12 or 13 years. So you could invest through QQQ. FTSE, which has been a laggard, but which should gain more momentum with the opening of the Brexit and the reflation rate which is coming in. So you got an option to invest through HUKX. And then if you want to diversify risk, you got an option to invest through iShares MSCI index as well, which is ACWI. So the ETFs have been quite popular. Funds, again, people prefer specific sectors, and then they pick up funds within those sectors to invest. The most popular ones has been the growth funds, because people have been favoring growth over values, and it has paid off to investors in the last 10 years or so. So the most popular ones among UK investors has been the Scottish Mortgage SMT, which invests in the leading technology firms of US, and it has given significant returns to investors in the last 5 years or so. The other ones is, people don't want to ignore China because of its growing presence in the world market and its world leading companies. So the likes of Bailey Gifford, who are very good investment managers, they've got a fund called as Bailey Gifford China Growth Fund. And similarly, you got growth funds like USA. So this has been few options for people to invest in growth. Market cap, where people have been more trying to favor the small caps, because they are the one who are giving multi-bagger returns. People have looked at the most popular ones like the Marlborough Nano Cap Growth, or the UK Micro Cap Growth, or the SLS Standard Aberdeen UK Smaller Companies Growth Fund. Emerging markets, again, because people favor emerging markets, especially the ones which are growing exponentially. So people have been looking at funds to invest through in funds to gain access to emerging markets. So you've got the likes of BNY Mellon, JP Morgan Emerging Markets, you've got Fidelity, and people have also been looking at specific markets like India. So people can invest through JP Morgan India Investment Trust, right? REITs, the most popular UK REITs are the likes of Primary Health Properties, Tritax, Big Box, Warehouse REIT have been the most popular ones. And the last one, shares, I mean, which normally people do tend to take an approach to invest in specific shares. The most popular of them has been the FANG shares, which is Facebook, Apple, Amazon, Netflix, Google. Of late, the electric vehicle shares have been in the limelight, so people have been investing in Tesla, NIO, etc. The trend has been towards digitization, so the likes of new companies which are using the technology to reach out to the consumers directly, the likes of Etsy, Uber, Deliveroo, Just Eat, Ocado, right? And then software technology, which has always been popular, but there have been some stocks which are the large cap stocks which have been outperforming significantly in the last 10 years or so, the likes of Microsoft and Salesforce. So this has been it's been observed that generally these are the routes retail investors are following to actually invest in equity asset class. Okay, so moving on. I mean, we've been through. We're not yet out of pandemic, but things have changed a lot in pandemic, right? I mean, people have been looking at themes where to invest or where would you get the next leg of growth in equities, and what themes we could look at. Because by and large, if you look at as Ashok Bhai has mentioned, right, the index have gone up significantly, and the valuations already look stretched. So it's more likely that the index could stay sideways, but then we have to look for specific themes to derive growth, right? And these are the emerging themes which we're looking at. One is electric markets, which is quite promising. So if you look at this graph, what is the projection says that right now we're sitting in single-digit percentage of electric market share, but that's going to grow up significantly with a lot of policy support from government, and it's likely to go upwards of 0.25% by 2030, which is going to be significant. The other one, which is gaining more popularity now, is the reflation trade, because as we are moving, as the economies open up, the massive stimulus and the significant liquidity in the market, we are expecting inflation to go up, right? And that theme is actually playing up now with rising yields as well. And if you see this graph, copper, gold, and treasury yields, the yields are slowly inching up towards 1.4, 1.5. Copper is at all-time high, and the copper to gold ratio is also looking promising. And the next one, ESG, sustainable investing and renewable energy. That's where the next growth is going to be, because people are moving away from fossil fuels to renewables. Okay, so let's pick up the first one, which is electric vehicles. This is the supply chain life cycle. So if you look at in the supply chain life cycle, we'll focus on the one where we got most promising opportunity, right? You got electric vehicle manufacturer, European countries increasing spending, Volkswagen and BMW have increased their significant capex on EV with new models coming up, but everyone needs battery, right? And at least 16 new lithium battery gigafactories are planned in Europe over the next 10 years, and battery manufacturers are partnering with miners locally to secure the raw material, right? And what raw materials are required for batteries? It's basically lithium, cobalt, nickel, and of that, lithium is likely to be the most in demand, right? And EU has recently added lithium to a list of critical materials to support locally. The most important thing is it's not easy to bring a mine to production, because they've got a long gestation period of approximately 5 years to bring mines to production, right? So that's where the opportunity lies, in raw materials, and investing in miners who can actually bring lithium to production.
So,
moving on, electric vehicles, right? I mean, so as I said, rapid growth forecast. So lithium demand is expected to grow at least by six times by 2023 as EV adoption increases and battery sector expands. And you see, I mean, the amount of battery which is required in all the appliances and the vehicles which you're going to use. So right from smartphone, which uses a 3 gram of lithium, all the way to storage devices, which would use around 500 kilogram per megawatt, right? And
Sorry,
the
Naren bhai,
consumption, yeah.
to interfere. So, I mean, would it be okay to just pace up just so we can get more time to discuss? And, you know, if you're okay, we can share that. This is really excellent information to share with the team as well. So, but yeah, that
sure.
would be great. Thank you.
Okay, and the lithium consumption is also expected to grow up significantly from 250,000 tons to around 2 million tons over the period of next over the period of next decade or so. Yeah. This is the European battery downstream sector, right? I mean, so you got people who would mine lithium, then you would have companies which would process lithium, produce cells, and then it would be made into batteries. So there are a lot of companies who actually are looking at Europe to establish themselves. So battery supply chain investment opportunities. I mean, so you got opportunities to invest in raw material suppliers, as I mentioned. So basically miners, and then you've also got an option to invest in battery suppliers and technology provider, because agnostic of this, every car company or electric vehicle manufacturer would have to partner with a battery supplier to actually source battery. And some of the stocks, especially in US and UK, which are looking quite promising, the miners who are at an advanced stage of starting their production, and they're partnered with bigger battery manufacturers to de-risk the projects, are highlighted in green, which you can certainly look at. So like European Metal Holdings, Bacanora, they all are at an advanced stage. They have raised recently capital, and they've de-risked the projects by partnering with some of the bigger battery suppliers like Ganfeng. All right, so moving on to the next theme, which is reflation trade. So what's reflation? So basically reflation is the turning point and first phase of economic growth towards inflation, which is what we are seeing now, because with the opening of the economy, we are looking at higher GDP growth. In US, the consensus forecast is around 6 to 8%. We are looking at rising inflation, a moderate, not too high. Central bankers are now looking at average inflation rather than a point of inflation target at point of time. And we're looking at a rising yield curve. So these are all perfect recipe for equities growth, right? And what is reflation trade? So basically a reflation trade means that some prices of assets are more sensitive to firming inflation and economic expectations, and they tend to outperform, right? So investors, they would bet on risky assets to hedge against inflation, and the sectors to bet on would be commodities and consumption stocks because they tend to outperform. Banks, even they benefit with rising yield curve because they tend to get higher net interest income. And with economic growth, the loan loss provisions also go down with GDP growth as well. Investment opportunities, for commodities, you can invest in basic resources, especially with copper being expected to be in high demand for the foreseeable future, both from underinvestment and also supply constraints. So you got the likes of Rio Tinto, Freeport, BHP, Anglo American, Glencore, Vale, etc. And then funds, you could also invest in funds rather than investing directly into this. You got the BlackRock World Mining, you got the GIGB, which is the Vectors Global Mining. Financials, the US stocks, the US financial banks are in a much healthier position than the European ones. So you could look at those banks, and some of the European banks are looking good as well. And you can also look at funds to basically invest in them. Okay, the last one is renewable energy. So this graph shows that wind and solar photovoltaic would basically overtake most of the other forms of energy production in the next 4 to 5 years, right? The Paris Climate Accord and most of the countries now resetting their emission targets for the next decade or so. So the markets would definitely accelerate for renewables. There is sustained policy support to shift towards renewable as well, especially with the new US government coming in, and they're promising to invest more money there. And we clearly see renewables which will overtake coal as largest source of electricity generation worldwide by 2025. All right. So with renewables, you would see that you need significant infrastructure to support renewables, and so the underlying demand would come from some of the resource materials like copper, because you would need significant infrastructure to actually transmit the renewable energy. You need silver and other materials to produce solar photovoltaic cells. And then you got battery storage solutions to store batteries. So you have significant opportunity to invest there. And then you got companies which are coming up with new fuel cell technology to basically derive renewable energy, right? So if you look at the options here, investment options, you got raw materials, you can invest in copper and silver. Again, some of the same companies which I shared in the previous slide, you got stocks, you can invest there. You can also take an exposure through funds. Wind power, again, developers and producers. You got stocks like Ørsted, Vestas Wind, which you can consider. Solar power, which again is getting more and more popular. So you got photovoltaic producers, you got inverter. I mean, you got people who produce inverters to process and store energy, and you got electricity providers as well. So you got a host of stocks there. And the most important of them is the fuel cell technology providers and battery storage, who are expected to do better of all the lot. And you got options to invest through stocks, which I mentioned there. And you can also look at one of the leading fund, which is INRG. You can also look at an index, which is Renix World Index, which tracks 30 largest renewable energy companies, and you can pick stocks from there as well. Okay, in the interest of time, I stop here and we'll cover specific questions there. And the last quote, which resonates with Jito's motto as well, which is empower your knowledge towards successfully financial planning to attain financial freedom. And with that, we'll move on to the Q&A with Nitin's permission.
Thank you, Narendra. Thank you. This is really an eye-opener as well as a really great detailed insights. It's really fantastic to hear you there. Can we, sorry, stop sharing so I can, please?
Nitin, can we do the quick poll?
Yes, please. While I'm setting up the share screen, if you want to do a quick poll, please.
Thank you. I'm going to be publishing a quick poll. If you can let us know what in future events you would like to see related to share market. So all you have to do is just select multiple options. It is a single question. I'll share the results after this. If you have something else, please do send us an email at info@jitouk.org, and we will try to fit as many as possible. Okay, more stocks and market trends seems to be leading. How many have I got? Okay. Only 23 people seem to have voted. If others, I'll give another 10 seconds. Nope. Okay, stop and share results. So you can see that we have got a clear winner of more stocks and market trends, then financial instruments, capital raising for growth and expansion. Any others, please do send the email across to us. Thank you.
Thanks, Anurag. It's been fantastic to see people liking it, of what we are bringing here, the expertise and the know-how, and as well as insights from macro, as well as the deep insight from specific stocks from there. So that's great. Now it's the time to start a Q&A session. Of course, we're running slightly late, but I'm sure it's a Sunday morning, afternoon, and everybody's going to be if they are enjoying, so wouldn't mind stretching a bit. So before I start the questions, so I think what I would like to do is just to be precise, the questions will be mainly focusing on both Ashok Bhai's as well as panels, but please keep sending out your questions via chat. So the first one for Ashok Bhai, we have a question from, are we going to see negative interest rate in the UK? And what's your thought about where are we heading in terms of interest rate? Ashok Bhai, are you on? Great.
Okay. It is unlikely that now we are going to see negative interest rates in UK simply because the government fiscal plans have continued to increase even further. And then the expectation that the economies can open much more fully Q3. Boris Johnson already announced the timeline to open. It basically means that there is no need for interest rates to go negative at this point in time. If anything, the markets are now bringing forward the point at which interest rates are going to be raised, as I said earlier, by about 12 months from earlier expectations. So I think even though negative interest rate remains in the toolkit for Bank of England, I don't think it will be used in the next 2 quarters.
Thank you. And I don't know, there is no sign of from the government side, but is our UK people expected to have any kind of a small package coming in our bank accounts like the Americans have seen, or it's something very unlikely, Enmo?
I think we have far more targeted ways in which the helicopter money is getting delivered. I don't know if you were listening to Rishi Sunak this morning on Zuma show. He was giving hints as to what he's going to do for this coming next week budget. Unlikely to be generalized. It's much more targeted those who are hurting the most. That's where the aid is going to be given.
That's great. Thank you. Ashok Bhai. I'd like to just extend the question to Narendra Bhai in terms of, Narendra Bhai, what's your thought in terms of, keeping the interest rates in anyway, and, the valuation of stocks is already, overhyped as well. So do you think there will be corrections once the interest rate goes, to slightly increase, or what's your thought on that?
Well, I think, if you see interest rates as such, we have been living in ultra low interest rate, especially in Europe for the last 10 years, right? European Union as such has struggled to come out of negative interest rate in the last 6 years. And I don't see that scenario changing, because or any central bank, it's easy to enter this the environment of negative interest rate, but very, very difficult to get out of it. So I think that's one of the reasons why Bank of England doesn't want to go into that territory at all. And I don't see them getting there. Right. And given that we have, the bankers, central bankers are now so much infatuated to stock markets, especially the moment there is a 10-15% correction, rather than, before the institutional investors react, they are in a rush to basically set the market expectation that there would be sufficient funds. We are not going to raise interest. Just look at what happened in 2018, 2016. There were talks of taper tantrum, and immediately they reversed their stance. And given that we have still not out of pandemic, I don't see central bankers going back and raising interest rates, at least for the next 2 to 3 years. And with the Fed James Powell, he has made it very, very clear. He's given such a long forecast that he's going to keep interest rates ultra low for the next 3 years, 2023, because they all want to pump up the capital cycle, because until that happens, they can't revive employment, and without employment, you won't get purchasing power in the economy, and everyone wants inflation, right? Because that's the way to get out of the debt for the central bankers. Otherwise, they can't reverse this balance sheet which they have created in the last 10 years. It's impossible for them to reverse that.
That's great. Thank you. And do you want to add anything, Ashok Bhai, to that point, or?
No, I think the anxiety in the market really has been the change in the inflation expectations in the last 2 weeks in particular. And the change in inflation expectation is simply a result of the fact that, we're going to have a mini economic boom. But of course, the inflation expectations have changed, and therefore the view on interest rates have changed. A lot of that is short-term drivers. We've seen very strong increase in the oil price. We've seen on average 10% increase in food prices around the world. The global food price index is up 10%. But food is a very small component of the developed world. But for emerging economies, it can be 30% of the CPI. And then, of course, we have had a big run up in the commodity prices. So there is a short-term upturn in the inflation, but that can only be sustained if the prices rise yet again, which is unlikely. So yes, inflation will go up a bit for the next 6 months, but then a year from now, they'll be trending down quite fast. So there is no need for interest rates to change the direction here and now, even though the markets are very, very agitated.
Perfect. That's great to have that. We have another question from one of the audiences about, we have a sheer amount of quantitative easing, right, from most banks across the world. And so with that kind of stimulus package, I guess the markets, euphoria will continue to remain in this way, or what do you think? I mean, there'll be settlement or stabilization on the market. Ashok bhai.
Okay, so I mean, clearly, when central bankers are creating new money, new liquidity, the money has to go somewhere. It just can't sit on cash because cash is either zero or negative yielding. So the mere fact that the quantitative easing is continuing is driving the risk markets up, and it's actually forcing all investors up the risk curve. And that is enforced by the fact that if central bankers keep continuing to buy low risk assets, which are government bonds and corporate bonds and so on, then those holders who sell to the central banks end up with cash, which they have to reinvest. So in a way, the markets are going to be held up until the QE is stopped or reversed. And the reversal may take some time because it will destabilize too many things in one go. So for now, markets are expensive, but they're destined to remain expensive. But whether we can make solid further ground in the market in aggregate, I think that becomes a little bit more difficult to determine. And what I was trying to explain was even the market expectations on corporate earnings growth are very, very optimistic and bullish. But you got to go under the hood and actually differentiate different sectors. And the sectors that are going to benefit the most from the opening of the economy will continue to behave. Companies that benefit from the interest rates slope increasing, which are financial has already been identified, and so on. The fact that the world economy recovers, the biggest beneficiaries are the commodity cycle because they are early cycle beneficiaries. The emerging economies again benefits of the early cycle turnaround. So you got lots to choose from, but there are a lot of areas one would say are fairly fully priced. Your prospective rate of return is going to be that much more inferior or poorer.
Okay, that's fantastic. Now, an interesting diversion I'm just taking around is, but it will be everybody's. It's hard to on this has been for last 5 years. So, Brexit is done, but pandemic is here. Are we settled with Brexit-related policies and changes, or we have much more to really learn and adapt from it? And also, what should you expect from Rishi Sunak on 3rd of March? Ashok bhai, over to you.
Okay, so let's just first understand what Brexit did. What Brexit did was basically put UK assets completely out of favor, including the real estate, the equity market, and the currency. As explained, the currency is already rebounds quite nicely. There's still more recovery left. Probably the long-term purchasing power parity is probably between 145, 150 against the US dollar. And of course, currency never trades at its fair value. It's either below it for 5-10 years and above it. It's quite likely it will shoot on the way up as the confidence returns, as the opacity, the lack of clarity that was holding it down begins to reduce. The sterling will continue to re-equilibrate. In case of the UK equity market, everybody who could sell UK equities have sold. So if you did not need to own it, then people didn't own it. Those who could take it to the minimum weighting had taken it to the minimum weighting. And as a result of that, UK equity markets ended up being the cheapest market of the developed countries. So if you look at the valuation gap between the UK equity and the US, it was as large as ever been. And now slowly, I think the pendulum is beginning to swing. And the reason is that the UK construction of the UK market is very different to the construction of the US market. The US market has very high, strong growth companies, in the technology sector, in the pharmaceuticals. UK really doesn't have any technology, real technology companies to speak of. So it has what I would call cyclical companies, metal mining, banking, and so on. So they benefit the most when the global economy is in acceleration mode, which it's going to be in the second half of this year, next year. So I think the UK index will have a very good time as the world economy recovers and the liquidity flows come back in. As regards to the core commercial real estate, office properties, and so on, We already seen, the likes of the Canadians and the like of the Asians coming in to buy very big ticket items if there are any available on the sale, because from their point of view, they had a double discount, the discount on the currency itself and the discount on the underlying asset prices, as this office properties and central London real estate is out of favor. That's the only time you can make big ticket items if you have a 10, 20-year time horizon. So again, I think you will find that the UK assets come back into favor slowly over the next couple of years, especially as its valuation advantages begin to shine and everything else in the world begins to become very, very expensive.
That's great. And that's great here, Ashok bhai, in terms of the Narendra bhai, do you think, are there any particular stocks to be keeping in mind from the UK, wise, or you think it's, having a diverse, any particular thoughts on?
UK, well, I think, you should definitely look at some of the mining stocks which are listed in FTSE and also junior miners, because they have been significantly underperforming since 2016 or so. They have just started picking up the pace since November last year, when the vaccine news was out, and they're gaining more momentum now with the reflation trade. It has been one of the most underperforming index in the world in the last 4-5 years because of a lot of headwinds with respect to Brexit, and the way the FTSE 100 index is structured with more exposure towards miners and bankers. So I would say that commodity space is a very interesting space to look at. And I think there are a few FMCG stocks as well, which could do well. The reason is, as FMCG stocks, they tend to perform well when you have moderate inflation or rising inflation in the initial stage, because they've got the pricing power to pass it on to the consumers. So there are a few stocks there which you can definitely look at, the likes of like Unilever and Reckitt Benckiser.
Perfect, and that's great. So moving on to the next question, it's very close to we as Indians. Is we Indian love gold and property, and I think what I would like to understand is going gold is becoming so Ashok bhai, over to you in terms of particularly considering to be that we might have a bear market in second half or sometime early next year once the money comes out from the stock markets. So is it safe to be continuing on gold at some point?
Let's just talk about a couple of the benefits of gold and then a couple of the negatives, and then try and figure out where we are in the cycle itself. So, gold, as you know, pays no income, but in the world of zero interest rates, there's no penalty in owning gold. The gold really loves negative real interest rates the most. The real interest rates go negative, the gold just keeps going exponential. And in that sense, the real interest rates are probably, we've seen the worst of the real interest rates being as steep as they've been, because inflation expectations are changing. Inflation might pick up a tiny bit. So in that sense, initially, the real interest rates actually become deeper negative. So a lot of that is already in the price. So in terms of the interest rate cycle itself, on the positive side, the gold has got a lot of it already built into it. Then gold almost benefits the most from uncertainties, flight to safety, stuff like that. And we've had plenty of that in the past. But right now, if the tensions in the global systems are coming down, uncertainty on elections in terms of US and Brexit and headline stuff like that is already reduced quite a long way. Uncertainty on vaccines and all that have come down a long way. So what that would have been typically a benefit for gold is now no longer a benefit for gold. But more importantly, I think that when you start looking at gold, always remember gold is priced in US dollar and it's counter-cyclical. So the gold does best when dollar is weakening. And we had last 12 months until very recently, a dollar had lost about 12-13% on trade weighted index. And that had been a massive driver for the gold. But now that the US forward prospects in terms of its relative growth advantage, relative inflation advantage, relative interest rate advantage are getting reestablished, there is no need to be frightened about US dollar, which is what the case has been for the last 12 months or more. So in that sense, the big driver for the gold, which was weaker dollar, is no longer there. And it might actually, the dollar could possibly recover some of the lost ground. So the gold remains, yes, good for the long-term value as safe haven. But I think that in the shorter term, it will continue to have a lot of headwinds. Of course, the ultimate reason that one holds gold is that it's 3,000 years of history of holding, real value. It's a store of value. And in a world of fiat money where central bankers are printing new money as if there is no tomorrow, then ultimately, sooner or later, some of this money may find its way into inflation, but that could be a long time in coming. And that will be your main way of maintaining real value of your assets. There are other ways to maintain real value of assets, not just gold, farmland, timberland, and stuff like that. So I think I wouldn't say that gold is not good at all, but I would say that, at best, it's probably going to go sideways with a little bit of down.
Sure. Perfect. Thank you so much. Now, moving on to property, I mean, there was a question particularly for Narendra Bhai about is, in terms of what's proportion of and in somebody's portfolio should have a real estate, that's one question particularly. So, what proportion you think you should be really investing in, properties or?
Well, I mean, traditionally, I mean, if you see people say that you divide your pie into 4 halves, right? Equity is 25%, 25% into fixed income, 25% into gold, and then 25% into properties or maybe cash, whatever it is. Yeah, I mean, if the thing is, I mean, it again depends from person's perspective. We all have got a fantasy about properties, but then if you compare properties against equities, it has always been an underperformer. So you always have to look at your overall portfolio and balance that out, right? I mean, so look at your risk appetite. I mean, what sort of liquidity positions you've got. So portfolio, I mean, property investment in the overall portfolio, if you have to rebalance, I wouldn't put it more than 20%.
Perfect. So I think we're just nearing to the time, and maybe last couple of questions I will take, if panel permits. One of the question is, of course, a lot of new hypes is happening around the cryptocurrencies. So to Ashok Bhai, what is your thinking about, will they ever become a mainstream? And what is it good or bad for the society?
Oh, well, that's a tough question. Very, very tough one. In terms of mainstream, I think it's very unlikely to enter mainstream. What will happen is that until the cryptocurrencies are actually issued by the central bankers, and there are already some central bankers working on it. And for the Chinese New Year, the Chinese central bank actually gave some Chinese central bank generated cryptocurrency as gifts to some random citizens just to see how it goes. So I think a lot of central bankers are experimenting in some way with cryptocurrencies. And I think if they find a way to make it work, then I think as for some people who need cryptocurrency for whatever reason, then that's going to work. And it's always been the fact that the amount of some of the production of the cryptocurrency like Bitcoin is actually limited. So there's a cap on how many can be put into circulation and so forth. But I think that if we're still in the very early series, and there are a lot of speculative write-ups that cryptocurrencies like Bitcoin can go up another 100 times and things like that. I think let's go ground zero.
Okay, that's great.
We are in a world where central bankers have injected huge amounts of surplus money. They continue to do that. So we are in a liquidity-driven tide. In a liquidity-driven tide, good, bad, and ugly is getting lifted. And the ugliest are lifted the most right now. And where there is hype and where there is speculation and where day trading is possible, the interest is most intense. But for the private real wealth management, let's put it like this. If you put 1% of your assets in cryptocurrency and you can afford to say it's going to zeroize and it will not change anything that I do, my standard of living, my working habit, etc., etc. But the upside is 10 times if it goes and if it really works. So I think you need to think in that terminology as a speculation rather than as an investment opportunity.
Perfect. Thank you. Narendra Bhai, just one line sentence or answer to you. My question is, would you recommend to anybody at the moment to say, go Bitcoin or just stay mum for some time?
No, I wouldn't invest in Bitcoin because by the time because I won't be able to sleep in the night. So
Okay.
I want a peaceful sleep.
Yeah, great to hear your thoughts then. So at least I'm sure it's much valuable for people who are online and hearing it. I would take one last question, and it's very interesting one, particularly from the audience has asked is, there's a lot of free money going in the West, particularly with excessive low interest rates and everything, and emerging markets are attractive enough. So would you see more money going into emerging markets like India, China, Brazil, all those kind of equity markets, or what sort of what will happen in terms of trends? Ashok bhai.
A wonderful question. Let's just get this right first. Emerging markets are not homogeneous, they're heterogeneous. So you got emerging markets like India, where the domestic economy is huge and doesn't depend too much on the world economy. Then there are economies like which are commodity driven or oil driven, and then are economies that are driven by agriculture and export like Argentina and so on. And then you got economies like Asia, which are much more manufacturing, advanced and developed and all that. So they all have different roles to play in terms of where you would use them in construction of your portfolio. So the nature of the emerging market composition has changed dramatically in the last 10 years. So if you look at the EM, the emerging market index for equities, for example, the Chinese equity weighting has already gone through 40%, and it's probably going to be 50% soon. If you look at the construction in terms of the sector weightings for the emerging market equities, 10 years ago, they were heavy in commodities and in financials and in real estate. Now, Chinese index is now more than 40-50% in technology companies, software and so on. So the way I would put it is that the Chinese indices are much more like NASDAQ indices, okay, QQQ, in terms of their behavior. So there's a lot more technological content. There's a lot more high-end manufacturing from Taiwan, Korea, Singapore, Malaysia, and so on. So that's the first point. The second point I was going to make, which I said earlier, was that typically emerging markets are beneficiary when the world growth is in acceleration mode. That is the best time that these things perform, their currencies and their equity market and everything else. That's when the liquidity flows into them. But they are very sensitive because, as I said, the construction of the underlying inflation indices in emerging economies are very different to the construction of the indices in the developed countries. Much higher weighting in terms of food and energy and so things like that. So they're very sensitive to these prices going all over the place. So the interest rate structure tends to be a little bit higher up there in emerging economies. And from time to time, they run very, I would say, disappointing monetary policies. A lot of populism goes in short election cycles and on that. So the currencies tend to be very volatile. Current account deficit can get out of control. So you got to sort the good from the bad. And you got to simply say what part of the emerging universe, emerging equities or emerging market fixed income do I want, and why do I want it in construction of my portfolio? And because there are so many choices, you can always find the right one to suit your needs and requirements. There is no generalized answer to that.
Sure. Perfect. Thank you, Ashok bhai. Very quickly, Narendra bhai, in terms of, would you pick up any or recommend any specific emerging market equity or in the, ETF trades or index funds?
I think, there are a couple of emerging markets. If you look at as Ashok bhai mentioned, it's more of a heterogeneous market. You need to specifically look at specific regions. So India has got the demographic advantage, and it's coming out of pretty low GDP growth, and it's expected to grow, and there have been a lot of structural reforms. So that's one market to watch out for. The other thing is the Latin American markets. There's been significant currency devaluation, and we're expecting a commodity boom. So that's one market to look at. So there are a couple of funds which are available there. One is, you can look at it for India. You can look at JP Morgan or Fidelity India Focus, and for Latin America, you could look at the ASI Latin America Fund to gain some access. Yeah.
Perfect. Thank you so much. I would have to close the session because I think we can go on as we have more questions coming in from chat, but it's definitely never enough from experience and expertise, especially Ashok Bhai, like Ashok Bhai and Narendra Bhai. So thank you both. Excellent debate and really energizing, and I'm sure participants loved it as well. So now I would like to invite our Secretary Sulabh Jain to give a vote of thanks to speakers. So please, Sulabh, over to you.
Yeah. Can you hear me all right?
Yep.
Thank you so much, Nitin, and Jai Hind, everyone. On behalf of Jito UK team and entire board, may I extend my sincere thanks and hearty vote of thanks to Ashok Bhai and Nayan Bhai for sharing us your thoughts and ideas today. Ashok Bhai has been very kind to Jito UK right from the inception, our inception, and always extended a helping hand and guided our community. And may I request that may this continue. Many thanks also to Naren Bhai for taking time out on weekend for a community cause, and we hope to have him again in future. Many thanks to our sponsors, Comline and Divesh Bhai, who have been very generous in sponsoring us. And also, I would be remiss if I don't thank our board members, especially Nitin, Amit, and Anurag, who have been working tirelessly to make this event successful. And without their effort, we wouldn't have such a well-organized and a well-designed event. And at the end, just my heartfelt thanks to audience for attending this event and supporting us, which encourages us to make more of such events. And please feel free to reach out to us if you're interested in a particular topic, either as an audience or contributing on the topic or becoming a Jito member. Thank you so much.
That's great. Thank you, Sulabh. And again, many thanks to everyone. End of session. Have a great rest of Sunday.